great day to everyone. Thank you so much for being here. For the last presentation of this day, it's going to be a great one. We are pleased to welcome Avi Gilburt, uh, founder of ElliottWaveTrader.net. Avi is an Elliott Wave market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by him and a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha, including MoneyShow.com. Avi, thank you so much for being here. Always a pleasure. It's all yours.
Thank you so much for having me again. Okay, good afternoon, everyone, and thank you for joining me for a discussion of our financial markets. My name is Avi Gilbert, and I run, as Mark said, ElliottWaveTrader.net, which is a website dedicated to understanding markets based upon market psychology. So for those that have followed me through the years, you probably know that we've called most of the major turns in the markets we track during the 12 years that we've been open. So I want to start this presentation with some background as to how we do that. So I'm going to give you a very quick lesson in the theory and application of Elliott wave analysis. And then I'm going to explain what I'm looking for over the coming weeks to months to determine if the market is setting up for a crash or not. So let's get started. Now, until the time of R. and Elliot, who discovered Elliott wave analysis, the world applied the Newtonian laws of physics to as analysis tools for the stock market. Now, basically, these laws provide that movement in the universe is caused by outside forces, which is what most people believe about the stock market. And Newton formulated these laws of external causality into three laws of motion. One, a body at rest remains at rest unless acted upon by an external force. Two, a body in motion remains in motion in a straight line unless acted upon by an external force. And three, for every action, there is an equal and opposite reaction. But as Einstein stated many years later, and I quote, during the second half of the 19th century, new and revolutionary ideas were introduced into physics. They opened the way into a new philosophical view differing from the mechanical one. Yet even though physics has moved away from the Newtonian mechanical viewpoint, financial market analysis has not. As Ralph Nelson Elliott noted, quote, in the Dark Ages, the world was supposed to be flat. We persist in perpetuating similar delusions. So let's look at how most people view the market. Robert Prechter provided us, there we go. Robert Prechter provided us with an accurate depiction as to how most people approach the market in his seminal book, The Socioeconomic Theory of Finance, which I strongly urge every single person who is listening to this presentation to acquire and read. It is an extraordinary book that will open your eyes and mind in ways that no other book on markets will. So what Mr. Prechter said was, as you can see, observers jobs as they see it is simply to identify which external events cause whatever price changes occur. When news seems to coincide sensibly with market movement, they presume a causal relationship. When news doesn't fit, they attempt to devise a cause and effect structure to make it fit. When they cannot even devise a plausible way to twist the news into justifying market action, they chalk up the market moves to psychology, which means that despite a plethora of news and numerous inventive ways to interpret it, their imaginations aren't prodigious enough to concoct a credible causal story. Most of the time, it's easy for observers to believe in news causality. Financial markets fluctuate constantly, and news comes out constantly. And sometimes the two elements coincide well enough to reinforce commentators' mental bias towards mechanical cause and effect. When news and the market fail to coincide, they shrug and disregard the inconsistency. Those operating under the mechanics paradigm in finance never seem to see or care that these glaring anomalies exist. However, Ralph Nelson Elliott offered us a different perspective of markets almost 80 years ago. Elliott said, Very extensive research in connection with human activities indicates that practically all developments which result from our social economic processes follow a law that causes them to repeat themselves in similar and constantly recurring series of waves or impulses of definite number and pattern. The causes of these cyclical changes seem to clearly have their origin in the immutable natural law that governs all things, including the various moods of human behavior. Causes, therefore, tend to be relatively unimportant in the long-term progress of the cycle. This fundamental law cannot be subverted or set aside by statutes or restrictions. Current news and political developments are of only incidental importance, soon forgotten. Their presumed influence on market trends is not as weighty as is commonly believed. Now, in fact, recent studies have begun to prove Elliott's theories from 80 years ago. In a paper entitled Large Financial Crashes, published in 1997 in the Physica A, a publication of the European Physical Society, the authors, within their conclusions, presented a really nice summation for the overall herding phenomena within financial markets. And they said, stock markets are fascinating structures with analogies to what is arguably the most complex dynamical system found in natural sciences, the human mind. Instead of the usual interpretation of the efficient market hypothesis, in which traders extract and incorporate consciously by their action all information contained in market prices, we propose the market as a whole can exhibit an emergent behavior not shared by any of its constituents. In other words, we have in mind the process of emergence of intelligent behavior at a macroscopic scale that individuals at the microscopic scales have no idea of. This process has been discussed in biology, for instance, in the animal populations, such as ant colonies, or in connection with the emergence of consciousness. Now, what's even more amazing is that there is now research that proves that the market would basically act as we see it on our current price charts, even if we did not have any news or fundamentals. In 1997, the Europhysics Letters published a study conducted by Caldarelli, Marsili, and Zhang, in which subjects simulated trading currencies. However, there were, and I underline this, and I didn't underline it on the presentation, but underline this, there were no exogenous factors that were involved in potentially affecting the trading pattern. Their specific goal was to observe financial market psychology in the absence of external factors. One of the noted findings was that the trading behavior of the participants were, quote, very similar to that observed in the real economy. So you may want to reconsider the common view of markets as being driven by news. Instead, consider that external events affect the markets only insofar as they are interpreted by the market participants, you and I. Yet such interpretation has been guided by the prevalent social mood. Therefore, the important factor to understand is not the social event or piece of news itself, but rather the underlying social mood, which will provide the spin to an understanding of that external event. Consider how many times you've seen the market react to a news event, yet the reaction was the complete opposite of all expectations at the time. The most recent and glaring example would likely be what occurred at the low we struck on October 13th, 2022, just about a year ago, which kicked off this rally that went from 3,500 on the S&P to 4,600 on the S&P. Now, if you remember at the time, most were calling for a further 5% decline in the market. Some were calling for even more. If the CPI report came in hotter than expected. Well, the CPI report did come in hotter than expected, yet the market rallied 6% off the morning low struck that morning. Not only did we get 5% or more than that as a move, but we got that and more in the exact opposite direction compared to what everyone was expecting at the time. Now, allow me to take a moment to show you what I was telling our clients at the time. The night before we struck that bottom, this was in my evening report to our clients. Thus far, the market has made several attempts at hitting the blue box support region on the 16-minute SPX chart. And each time, divergences continue to grow. And if you look at the 5-minute SPX chart, there's still an opportunity to actually strike that support below as long as we remain below the smaller degree resistance noted. But I think, and this is the key part, but I think we will likely be much higher than where we stand today as we look out towards the end of October or even into early November, depending on how long it takes the market to bottom out and how fast the rally I expect takes hold. I think we all know what happened that next day after I put out this report. But what was most astounding was the reaction by many in the market. Now, these are just a sample of what people were saying later that day or even the following day, with the second quote actually taken from Barron's. I'll give you an opportunity to read that. But what really astounded me is when they said it made no sense. There wasn't any new data. There wasn't any headline-making speeches, no event that occurred to spur such a move. It came out of nowhere. Well, it really did not come out of nowhere. It's just that they did not know where to look. You see, the difference between the ones that were surprised and the ones that were not is the perspective as to how to view news within an understanding of market sentiment. While news can certainly act as a catalyst, and often it does, the substance of that news is not terribly material to the direction of the market move. We've all seen it happen many times before, wherein the market reacts exactly opposite of the common expectations derived from the substance of the news. And that is because it is the overall market sentiment which tells us how the news will be interpreted, how the market will react, not the substance of the news itself. That is how I was able to identify the market is likely going to rally no matter what the news was on October 13th. Now, mind you, we were actually looking for a bottoming in that 3,500 region with a minimum upside target of 4,300. My high-end target at the time was 4,505. We even exceeded that a bit. Now, when the market reacts, let me get back to this now. When the market reacts as we expect it to react, it only reinforces the common belief of looking at the market through the wrong lens. But when the market reacts exactly opposite of the common expectation, most will simply ignore it and move on. But it is within this reaction when one can truly learn how to view the market through the appropriate lens. So now let's delve in a bit more deeply into how Elliott wave analysis works. And it'll give you a basic understanding of how we approach the market and how news is not necessarily important to us, as you saw from the October 13th low.
Hey,
Back
Avi,
in the 19th,
excuse me.
Yeah.
Real quick, the slide that we're seeing, it looks like it's on the quote from Barron's, October 14, 2022. Is that the slide you're on?
Yes.
Okay. We just wanted to make sure because it was up there for a bit and we didn't know if it was frozen.
No problem. Back in the 1930s, there was a gentleman named Ralph Nelson Elliott who discovered that movements in the market are really a repeating fractal of overall societal sentiment, which is governed by the natural law of the universe as represented through Fibonacci mathematics. Now, as I quoted Elliot earlier, he said, very extensive research in connection with human activities indicates that practically all developments which result from our social economic processes follow a law that causes them to repeat themselves in similar and constantly recurring series of waves or impulses of definite number and pattern. Now, Elliott recognized that, that stock market was driven. By the way, I apologize. This is actually what our clients said the following day the same day, actually, on October 13th, when we caught that bottom. So I'm just going to put that out there. Let me move on. Elliott recognized that the stock market was driven by waves of public sentiment, and that those waves of sentiment are fractally patterned. This means that markets take shape with invariably self-similar patterns at all degrees of trend. And I'll explain this further in a few minutes. Most specifically, Elliott theorized that public sentiment and mass psychology move in 5 waves within a primary trend and 3 waves within a counter trend. Once a 5-wave move in public sentiment is completed, then it's time for the subconscious sentiment of the public to shift in the opposite direction, which is simply the natural cycle within the human psyche and not the operative effect of some form of news. Now, while some of you may question how sentiment can just turn on its own at these extremes, I'll simply explain that many studies have been published over the last 30 years, which explains how it occurs naturally within the limbic system of our brains. Now, when I said that the market is fractal in nature, in other words, variably self-similar at different degrees of trend, what I mean is that each 5-wave structure can be broken down into further variably self-similar structures. Now, if you look at the chart, you'll see that waves, Roman numeral waves 1, 3, and 5, each break down into 5-wave structures themselves. And I outlined that just for wave 3, but waves 1 and 5 do so as well. Waves 2 and 4 are actually counter trend moves within the 5-wave structure, and they break down into 3-wave structures within this larger degree structure. This is the basic Elliott wave structure that you need to understand. Now, before I get into my perspective is where I think we are in the market, I want to tell you that a market prognostication made by Elliott back in the early 1930s. Now, before we get into that, I want to put ourselves back into that time period and understand the frame of mind of people in those days. World War II was raging around them at the time, as the US was just entering the war at the end of 1941. And the next 4 years saw some of the most horrendous fighting in world history. It truly was a period of ultimate negativity around the world. Yet Elliott somehow made the following prognostication at the time. He said that 1941 should mark the final correction of the 13-year pattern of defeatism. This termination will also mark the beginning of a new supercycle wave 5, comparable in many respects with the long advance from 1857 to 1929. Supercycle 5 is not expected to culminate until about 2012. Now, for those of you that don't understand what Elliott is saying, Elliott was forecasting a 70-plus year bull market while World War II was raging around him. This has to be the best stock market prognostication in history, bar none. So now I'm going to build upon Elliott's work and stand on the shoulders of giants, as they say, and explain what we're seeing in the very long-term chart of the S&P 500, so we can consider where we are today within this larger 5-degree wave structure that Elliott was prognosticating. And from here, we will start drilling down into smaller degree time frames so we can have a better understanding. Now, let's start with the left side of the chart. And as you can see, everything moved up into 1929. And the top of 1929, you see a Roman numeral 1. Okay, and you see a 5-wave structure into that move, and that's Roman numeral 1. 1929, we were then struck by the stock market crash, which did not bottom for till about 2-3 years later. I think it was 1932 we bottomed, and that is our Roman numeral 2. Now, after we have the 1-2, we're expecting a large degree wave 3 Roman numeral, right? Roman numeral wave 3. That is all the way at the top where we are today. I don't know if you could see me with my cursor around it, but that is the top of Roman numeral 3 where we are today. Now, if you look at the structure of this move up until the top of that wave 3, you'll notice that it also breaks down into a larger degree 5-wave structure. Now, what I want you to focus on is a little bit lower. I want you to look at the 2000 to 2009 time frame. And you could see the market basically went sideways during that 2000 to 2003 time frame. And if you look carefully, you could see a Roman numeral 3 at the top of 2000 and a Roman numeral 4 at the bottom of 2009. That means that the 2000 to 2009 correction was a wave 4 of this larger degree wave 3. So once you complete wave 4, you then have a 5th wave to complete wave 3. Well, what comes after wave 3 is completed? Well, a larger degree wave 4. And that's the wave 4 in Roman numeral, in the parens Roman numeral 4 on the chart, which is yet to come. It is for this reason that I have said my expectation is we should be heading into a very large and long-term bear market just around the corner if we have not begun it already. So with the idea that the 2000 to 2009 structure, sideways structure, is a wave 4 of this wave 3, let's move to the next chart and zoom in a bit more. As you can see on this chart, top of Roman numeral wave 3 is all the way on the left of the chart. Then it comes down to Roman numeral wave 4. And now I have broken down Roman numeral wave 5 into a 5-wave structure as well, and coming to a top as Roman numeral wave 3. As you could see, I have an alt 3 there, and let me explain that. First, for those of you that remembered our market call back in March of 2020, I was looking for a bottom in the S&P 500 approximately at about 2,200, and that's because of a more detailed calculation than you could see here. But 2,200 was our estimated expectation for the quote-unquote COVID crash to complete. And I believe it completed within, was it 11 or 13 points of our expected bottom. And if you remember, I said from there, and I said this even before we bottomed, from there, my expectation was we would rally from there to levels north of 4,000, my ideal target being between 5,500 to 6,000. Now, when we topped at 4,800 and change, the market pulled back a lot deeper than I had expected. I did not expect that we were going to break down below 4,000. I thought we would go to 4,800, and I thought we would pull back to 4,000 to about 4,400. Somewhere in there, my expectation is that that's where we held support. When we dropped down to 3,500, it made me consider that the long-term bull market actually completed in a shortened fashion than what I had expected. Now, I have explained this to all of our clients. If I was going to be an absolute purist, I would say we are going north of 4,800 as we look into 2024. And that's me being an absolute purist, because I don't see a fully completed 5-wave structure for this last segment of this rally. However, I also recognize that we are dealing with people's hard-earned money. So from a risk management standpoint, I explained that I am going to be approaching the rally. I expected a rally from 3,500 to at least 4,300. And I said I wanted to see how that rally was going to take shape before I was going to make certain and be confident that we were going to 4,800 plus to complete what I thought was a more ideal structure for that fifth wave and final move higher before the bear market began. The nature of the rally that we've gotten off of 3,500 has been extraordinarily overlapping and not what I would ideally call something that gives me high confidence that we're going to 4,800. Can it still happen? Absolutely. And I think the next few weeks are going to tell us if it's going to happen or not. Now, this is how I am looking at the two potentials I'm seeing on the chart right now. And this is what I've been writing about publicly, that yes, can we get a market crash from here? The answer is still yes, it still can happen. And much is going to depend on how we drop after this rally that we got off the 4,100 S&P 500 level completes. The way I'm looking at it right now, there are two options. One is the market's going to pull back correctively and then continue to the higher target box I have for the yellow 5 up here. The other option is the market is going to drop in quote unquote impulsive fashion. And that's going to signal that we are setting up to drop in a wave 3, which will probably, the wave 3 will probably just take us to the 35 to 3,600 region. We'll get a bounce, and then we'll come back down to here. These are the two options that are on the table for us right now. And very few people, I mean, I shouldn't say very few people, a lot of people have a hard time grasping that, yes, there are two possibilities that can exist until the market clarifies which of the two it's going to choose. Oops, okay. I actually didn't put that up. So you know what? I'm going to close this right now. And I'm going to take you to my 60-minute chart. And this is the chart that I think clarifies the nature of what we're looking for in the next 2 to 3 weeks. This is what we're looking for, folks. Should the market pull back in corrective fashion, meaning a 3-wave structure, then that's going to tell me that it's a corrective pullback, and then I'll be looking towards 4,800 plus as we look out to 2024. However, if the market takes a decline that subdivides into a clear 5-wave structure, well, that tells me, remember that wave 3 I showed you that's pointing us to about 3,500, 3,600 for the initial drop? That would be considered the market crash. And that would be considered 5 waves down for wave 1. You would then get a bounce for wave 2, and then you would proceed with your crash. What is very interesting is that it truly is the next several weeks, how the market plays out on its next pullback. Now, does that mean we're going to start pulling back tomorrow? It does not. This still has some room to go higher. And as long as we stay below 4,607, the potential for the market crash remains on the chart. And I have to tell you, it's not by a small percentage. I would probably say where we stand right now, I'm at 50-50 as to whether or not this market crash is going to occur. For me, it is all based upon the nature of the next pullback, as long as we stay below 4,607. Because if you break out over 4,607 in just this move here, you will still likely see a corrective retrace. But if you break out over 4,607, even by a few points, it invalidates the potential for the imminent market crash setup that I'm showing you here. So there are two things you need to look for in the coming weeks. One, do we go over 4,607 or stay below 4,607? Sorry about that. If we stay below 4,607, then you have to look at 2, the nature of the next pullback. If the next pullback is a clear 5-wave decline, then that is a strong signal that the market is going to set up. And the 5-wave decline would likely be pointing us back down to the 4,100 to 4,200 region. So it probably will be deeper than the corrective pullback. But even if you get that 5-wave decline, you still will likely get a corrective bounce thereafter in the wave 2. You get 5 down, followed by a corrective 2. This will be your last opportunity to raise cash and or short, because that is the setup that's pointing us first to 3,500 to 3,600. Ultimately, it could be pointing us as low as 2,900 to 3,300 in the full 5-wave structure to the downside. So, as I said, is this something I am guaranteeing you that's going to happen? The answer is no. I will, as the great example that I like to give is a weather forecast. You know, when you hear about tornado warnings, effectively what they're telling you is the environment, the weather environment is such that a tornado can develop on the ground, and they'll tell you where it can occur. I'm telling you the same thing. The environment below 4607 is such that a market can develop a crash down to 3,500 and lower. Doesn't mean it's going to happen. It means the environment is such. Should we remain below 4607 and only see a corrective 3-wave corrective looking pullback, that tells me it's time to go long, and I'm looking for 4,800 plus. That's what the next several weeks is going to be so important to me for. Okay. That is my general spiel. I can take some questions now if you guys have them.
All right, Avi, thank you so much. We had one viewer here. They're viewing on the side of the crash. They're wondering how would they prepare for the extended bear market there.
Well, you know, that's let me go to the monthly chart. This is the monthly chart that shows the extended bear market. Now, I want you to realize that this is a type of bear market that we really have never experienced in our lifetime. And the manner in which it will likely take shape is you will have multi-year bear moves and you will have multi-year bull moves within them, but they will not necessarily make higher highs. Let's assume that we have topped and we're going to start moving down for that little crash that I was talking about. It looks like a little crash from here, but that's 800 plus points. You have to remember, if you don't like shorting, what you do is you go to cash and you wait for the market to complete that decline in 5 waves. Once that completes, then what you know is you would expect a rally. And that rally is likely going to be a corrective rally, but it likely will also be a multi-year rally. I want to show you something here that most people don't really realize. Oh, come on. Most people really don't realize this. When we go back to 2008, so when we go back to 2000 to 2009, the market bottomed over here at the end of 2002. And then we began a multi-year rally, a 5-year rally. That 5-year rally, believe it or not, was considered a corrective rally. So you can see those multi-year rallies taking shape. So when you complete the decline, you reinvest. Then you hold on for a multi-year rally. And as this multi-year rally completes, go to cash again. Or for those of you that are aggressive, you short. And then you're going to get a larger decline. And then again, you're going to likely get a larger multi-year rally thereafter, followed by an even bigger crash to complete this very long-term correction that I'm expecting. Now, if you see the Alt 1 and the Alt 2 here, just so I'm sure somebody's going to ask, let me just explain what that means. There is nothing ever written in stone. when we view market analysis, we look at it as what is the most highly probable expectation, and then what is a secondarily probable expectation, and that is our alternative count. When I look at this decline that can happen over the next several years, that could take us minimally, the initial leg would take us minimally to 1800 to about 2200. Okay? There is some possibility, there is some potential, and this is my alternative count, that when you complete this, it is a bigger 1-2 structure in a much more extended wave 5 that's going to go much, much higher. Now, right now, that is truly way too far for me to even consider. It is my alternative now. Where is it going to make a difference to me? It's going to be in the nature of this rally off of here. If this rally is a 5-wave rally, well, then I am probably going to move into that perspective that this is a bottom of a 2. We're going to get another 1-2, and then we're going to break out, and we're going to have another decade plus long, maybe even a 2-decade long rally from there. If this rally is clearly corrective, well, then we're setting up for an even bigger crash, one that is bigger than the one we saw in 2009, in 2008, 2009. So you almost have to take it apart and understand the market context to understand there will be times to invest and there will be times to be in cash. So I hope I'm answering that question properly, because there's no one right way to do this, because there are going to be opportunities even during the declines. There will be charts that will have opportunity to have. There will be certain charts that will move indirectly with the market, will move opposite the market, and we'll find those. We look for those. Good place to put money, or just to leave cash in, just to hold on to cash. Cash will be much more valuable down here. Cash will be much more valuable down here. Cash will be extraordinarily valuable down here. So don't let people tell you cash is trash. Cash is always a relative commodity. It all will depend on where the market is and how much cash you hold relative to where the market is. If you own Apple at 100 and you then cash it out and Apple goes down to 50, well, you now can buy double the amount of shares. So keep that in mind. Other questions, ladies and gentlemen?
Question in regards to cash and bonds. There's say looking at the equity risk premium. Can equities compete with bonds and cash?
You're assuming that that bonds are going to remain at that 5% level. Not my expectation, but I don't want to go into. I'm not expecting another bond market crash, which will be worse than the one that began in 2020. I'm expecting a much worse bond market crash in the second half of this decade. So it all depends on timing.
All right, thank you very much. Another question here. They're wondering, should they be preparing to go to cash at this moment?
I'm always asked, should I buy now? Should I sell now? The answer is never a simple yes or no. It all depends on who you are, where you are in your investment career, how much risk you like to take, and how nimble you are. Let me show you this. Okay. I'm going to go back to the 16-minute chart. Now, let's say you're relatively nimble and you like to take risks. Okay? What you're looking for is you're looking for a corrected pullback to buy into for a rally higher. If you're not nimble, or if you don't like to take risks, you're raising cash here. And then you're going to wait to see how the market declines. And then if the market then begins to rally again over this region, you can always get back in and ride it again. Another way you can look at this, you could just hold what you have. And if the market declines in 5 waves, you then get to cash on the wave 2 bounce. There is no one right answer for this. And that's why I tell I have 8,000 clients, folks. And I tell them all, there's not one right way to do this. It really all depends upon your risk tolerance, where you are relative to retirement, how nimble are you? How comfortable are you moving in and out of the market? How much safety do you want? There's no one right answer to that question. But what I strongly suggest to each and every one of our clients, you have to know yourself. You have to know what your risk tolerance is. You have to know how comfortable you are, how nimble you are. You have to know yourself and be honest with yourself. Otherwise, you're going to fool yourself, and that'll cause a lot of problems. Be honest with yourself, know yourself, and then make a plan that fits for you and stick to that plan. Next question.
All right, just have time here for a couple of more. Let's see. Question here, while major markets around the world will likely remain fixated on treasury yield movements, should we focus on corporate earnings trends in the S&P?
Absolutely not. Earnings are often the last thing that you're going to be worried about. I know there are a lot of people that also, look, sentiment leads earnings, and I can go into a very, very detailed explanation proving that's the truth. I don't think we have the time for that. I've done articles on that. I've done other presentations on that. Earnings are not a consideration to me, even the slightest. I mean, how many times have you seen the markets stock move exactly opposite the earnings announcements, or even opposite the earnings expectations, the forward guidance? Earnings are not how you should make your investment decisions. And I'll be honest with you about this too. I know a lot of people invest for dividends, but I'm going to tell you, when we get into the heart of that bear market, your dividends will likely be cut. We have never, and people are using periods of time where, you don't have very long, extended bear markets. And the dividends weren't cut too bad, then I'll get my, no, this potentially could be an extreme bear market, extreme, more so than what we've ever seen. And if you are a dividend investor, my strong suggestion to you is to lighten up. Let's say you're going to hold your dividend stocks and we drop down to here. My strong suggestion to you is to lighten up on those dividend stocks up to here. Get some cash out of it. Let the market decline again. Go back into your dividend stocks here and just ride them for another 3-4 years thereafter. And if this isn't impulsive, folks, you better get out of those, because down here, dividends will get cut, companies will go out of business. So just consider that if earnings is your focus.
All right, excellent. Thank you. And to wrap us up here, Avi, we had a few people that are wondering, what's the outlook if the S&P makes a new high over 4,800?
Well, that's the all three, folks. In other words, it's just extending this final fifth wave. It's not changing the bigger structure. It's just giving us that higher high that I have wanted to see this entire time. Maybe we extend as high as 5,500. I don't think we're projecting that high at this point in time. Right now, 4,900 to 500 is probably the upside, 550 or so. That's probably the upside of what I'm seeing at this point in time. But once that completes, this very long degree trend completes, whether we get that higher high or not. It either has completed here or it's just going to complete here. That higher high is just another 4 or 5 and it completes. And then my expectation is looking for a very long-term bear market. Minimally, like I said, maybe we get lucky and we only go down to 1,800 to 2,200. But if you consider going from where we are now, 4,500 to maybe as high as 5,000, getting back down to 2,200, that's quite significant. So that's, in my opinion, I think whether we get that higher high, that one more move into 2024 or not, I'm not seeing, look, I have been praying that I am wrong in this assessment. I've been absolutely praying because the devastation that will come to many families, to many people, to society, the effect it will have on society if you think we're going to go through this in a very long, protracted bear market, will have dire consequences. I pray every day that I'm wrong, but as each day goes by, it just looks more and more likely that this very long-term structure is going to play out. If something changes in the coming years, I will be the first to let people know publicly, and I will be happier than most anybody because I don't want this to happen. This scares me. It scares me for my children, down the road, even for grandchildren. I would much rather not see this play out. But right now, everything still points to whether we get that higher high or not, it's still pointing to this structure. So I'm sorry to be the bearer of bad news or the bearer of potential bad news, because this is all based upon probabilities. But from a probabilistic sense, it's not looking good.
All right. Well, Avi, thank you so much for taking the time out today. Fantastic presentation. Always a pleasure.
I'm sorry to, I don't know if I can classify this as fantastic with this type of news, but I hope it was informative.
Absolutely. All right, everyone. And thank you so much for sticking around, attending this final session of today. Fantastic. Thanks for being here, everyone. We'll check back in with you tomorrow for the last day of the event. Thank you so much for being here. Thanks again, Avi.
Thank you.